This session is in 3 parts, and I apologise, it's slightly a technical session, but it's a very important session. I'm going to give a very short introduction to the classification of retail assets, always conscious that I'm talking to everybody who knows about retail assets. I'm then going to introduce Charlie Bark to come up and talk about the investment market and to give the context of it, and then I'm going to invite a panel up to then address questions on both the investment market and the classification. This is an interactive session, so I'm prompting you now to think of questions to pose, particularly around, and you can be as controversial as you like. In fact, the more controversial, the better. So please don't sort of sit on your laurels there. The background to this session is that each year we have a roundtable session of, and last year we had a roundtable session of chief executives, senior fund managers and analysts. And the issue was the liquidity in the investment market. Boy, it's not got any better. But the purpose was, what can we do to facilitate more liquidity, better understanding, better analysis of risk? And from that came a recognition that at the moment in the UK, we have a system of classification of assets that is very helpfully described as prime, secondary, and tertiary. And that, of course, tells you everything you need to know about the asset in question. Now, the reality is we take it for granted that we all do know what that means as professionals in the industry. But if you're an international investor looking to come to the UK, if you're an analyst trying to report on a listed company, if you're a bank looking to lend money into the sector, if you're the Bank of England trying to explain to the Chancellor of the Exchequer what's going on, that's not very helpful. And they all suggested to us that we should, and have been strongly supportive of the idea of coming up with a more factual description of what on earth these assets are. So far, so good. We took this on board. We have done extensive consultation through workshop groups, reaching out to valuers, to investment agents, to funds, to REITs, and we have come up with a classification through that process that is in a final draft form. And I'm going to run you through it, I hope. I'm not going to ask you to read the detail of it. It's on the app, and there'll be some handouts at the back. And I'm going to skip through and then come to a very short summary. And effectively, we've broken it into 3 groupings. And these groupings are trying to give a factual description of what the assets are. And there is a recognition that within these groupings, assets can often merge between 2 definitions. Revo's responsibility is to try and get a unified form of describing assets that the industry accepts and adopts. It is not Revo's job to tell you what assets fall within which category. That is for the market to decide. And it's also for the market to describe whether a particular asset within these categories is a thriving asset, or a poor asset, or a secondary asset in that category, but that's down to you to interpret. But we are, to remind ourselves, the only country in the world that simply adopts a current terminology of prime, secondary, and tertiary. So by adopting some form of standard, we are basically putting ourselves in line with global investment, which is important to bring back liquidity. In terms of next steps, so we've got this out, and I have to thank a whole range of people for their input into this. And this is, an iteration of drafts that have gone through. We're now putting it out for the market to now road test it. Obviously, with Christmas valuations coming up, for the valuers to try and use it, to interact with investors, and seek feedback so that in spring next year, we can come out with a final version of this, reflecting any adjustments that have come through. We know it's not perfect. We started out by trying to describe shopping centres, and the feedback was it has to cover all retail property. So inevitably, there is a slight bias in the way the language is used, geared to more town centres. It's supposed to cover retail parks, so it probably doesn't describe retail parks perfectly. Your feedback, your comments on that would be welcome. So we're not here presenting the perfect answer, but it's a a step towards a much better way of describing, and it will always be an evolving system. It's not fixed in granite for the next 30 years. You know, times change, and in fact probably some of the international standard changes will be adopting some of our best practice as well. So that's the backdrop to it. I'm just giving you that scene before I now introduce Charlie Bark to come up and give you the joys of the investment market and why we're perhaps doing this. Charlie, if you could come up. Thank you.
Morning all. A bigger audience than I expected on Thursday morning, I must say. It's always been quite quiet when I've been in here before, so hopefully an interesting topic. 5 minutes on the investment market. There's obviously a slight danger that this might be a fairly depressing 5 minutes, so for your own safety, if you've got any sharp objects, perhaps pass them to the back so that we get through this without any injury. So what has been going on in the investment market? Firstly, looking at turnover, and as you can see, an absolutely buzzing market this year, far from it. 2017, we recorded around 2 billion of shopping centre transactions. Our numbers include outlet malls, partly because Knight Frank did most of those. Other agents don't, and if you exclude those, it would only be about 1.5 billion. To year to date, around only 700 million of investment turnover. And as you can see, 2008 was the century low at just over 1 billion. And I think there is a realistic possibility that we might record the lowest volumes this century in 2018, probably until 2019. So who has been actively investing in the sector over the past 12 months? Well, the much publicised activity of the councils shows up here, representing around 25% of the market. But it may be a surprise to some of you to see that actually institutions have still been the main buyer in shopping centres over the past 12 months. I would, however, caveat that most of that activity was the end of 2017, early 2018. And since Easter, we've really seen hardly any activity from the institutional market at all. So why is the market seeing these depressed volumes at the moment? Well, this chart shows IPD returns over the past 15 years, quarterly IPD returns. The red line being shopping centres, blue being all retail, and green all property. And as you can see over history, shopping centres have broadly tracked both the all retail return and the all property return. Excellent. The last 2 years, we've seen a meaningful disconnect for the first time this century, really, where shopping centres have been a chronic underperformer, both to all retail and all property. And as you can see, over 2018, the quarterly return has actually turned negative. So even despite the income, the capital movement is such that it's showing a negative return. I highlight the stat at the bottom that since what I regard as the sort of turn of the market, which was the end of 2015, IPD has crystallised a valuation fall across shopping centres of 7%. That is the valuation correction we've seen in the shop IPD universe. So that's institutions, REITs, etc. I'll come back to that in a moment. I just want to touch on yield movement. And the first point to make here is you'll see that this yield graph uses the old terminology. We haven't yet adopted the new terminology into the yield time series, and that's a piece of work we need to do. The second point to make is this is Knight Frank's historic terminology, regional dominant, dominant prime, good secondary. I've stripped out other secondary because it's not relevant to IPD. But if you look at CBRE, Savills, Jones Lang, there are all sorts of different definitions, and some of the valuers adopt an average yield in the category, some a prime yield, and this is why we need a degree of uniformity. All the valuers need to use the same terminology, and we need to agree what these yields represent. Best in class, average, do we put a range in? But for now, I'm looking at the historic time series, and you can see that yields have moved out over the past 2 or 3 years, hence why we're seeing that IPD underperformance. Looking at that a little bit closer, here I put the yield movement into a potential valuation impact at that yield change. And you can see that the best schemes, prime schemes, having moved out 60 basis points, should have seen a 13% value correction. Dominant prime and good secondary on yield alone should have seen a reduction of around 24-25%. Now, that's not taking into account income. So if income has gone up, obviously value would have gone up. If income has gone down, and to be honest, most of the assets I've looked at over the past year or two have seen income go down in 2018, there would have been a greater valuation movement. So IPD's crystallised 7% reduction. I think value should have fallen 25%, and that 15 to 20% inaccuracy between valuation and where the market is what's causing great illiquidity in our sector. And I'm afraid that catch-up has to happen in the next 6 to 12 months. So that's the negativity. What about a crumb of comfort? Where might we go going forward? Well, this chart shows yield relativity to 2009 highs in terms of yields, low in terms of values, and the 15-year average. First point to make, at the prime end of the market, we're still actually trading at a premium to the long-term average, and we're at a significant premium to the 2009 level. Now, that partly reflects our confidence in this market. I think most of us believe that ultimately our regional dominant schemes have an excellent future. It's all about destination, it's all about experience, and so they're not anywhere near as vulnerable at the hands of the change we're seeing in the retail market at the moment. It possibly also partly reflects the risk-free rate being much lower than the 15-year average, and indeed much lower than it was in 2009. Nonetheless, I think that change has been held back by lack of evidence, and I would be surprised if 4 3/4 wasn't the other side of 5% by the beginning of 2019. As we move out into dominant prime, good secondary and secondary, you can see that the yields begin to look more attractive. And once we get into the secondary market, yields are at an all-time high and are beginning to potentially represent some value. And I think we're probably getting towards the end of where those yields need to move to. I don't think we're going to see good secondary go to 10% and the rest of secondary go to 12 or 15. But it's all about income stability in these schemes. So there potentially is still some NOI erosion. But I think if you can find the asset that has got stable NOI, genuine occupier demand, and you can buy at 8-10%, I suspect we're getting towards relatively good value compared to historic context. Looking wider to find some context of our yields, here I look at prime yields versus the French and German counterparts, and then other principal investment classes. And as you can see, our prime yields are looking quite good value versus our EU colleagues. They have got some pressure, and I suspect their yields are moving up. But for now, we offer relatively good value, and I think if that prime benchmark goes to 5-5.5%, that will look even more attractive. And certainly prime at 5% versus prime offices at 4%, prime sheds very near 4%, and secondary sheds at 5 3/4 is another interesting point. So historically, when an investor needed a high income return asset class, which is often a criteria fund managers have to chase at a point in the cycle, historically people move towards industrial typically. That is not going to be an option this time, and if an investor does need to get an income return up in their portfolio over the next 2 or 3 years, shopping centres are probably going to be about the only place you can buy 7, 8, 9% income return. And if you pick the right sort of asset, I can see that being popular again, but you have to be very careful about where the occupational market lies. Lastly, fortune does tend to favour the brave in some cases, and there's always an overcorrection when you see this sort of market. So going back to those turnover stats, 2008, disastrous year, only $1 billion of transactions. Perhaps 10 years later, 2018 is going to represent that similar low. And here, some investors made the brave call to invest in 2009-10. They bought assets where they fundamentally believed the NOI was stable and the long-term potential was sound. And none of these assets were transformed by these investors. These assets were simply held for yield movement over the course of 1, 2, 3, or 4 or 5 years. And you can see meaningful capital uplifts were crystallized by these investors who were brave enough to invest in 2009. Is that a 2019 opportunity or 2020? I suspect politics will dictate the timing of the bottom of the market, but there is going to be an opportunity at some point in the next couple of years. Thank you.
Charlie, thank you for setting the scene and actually giving a note of optimism and opportunity for the market, which is brilliant. If I could now invite the panellists up to the stage, please. There's Mark Robinson, Property Director of Alandi, John Duxbury, Head of Retail and Leisure at M&G, Lawrence Hutchings, CEO at Capital & Regional, and of course, Charlie, you just heard from. First of all, I'm always advised you should never apologise when you're standing on a stage giving a presentation or a panel discussion, but there is an apology. Revo has a very, very strong policy towards diversity. And whilst we may have a great diversity of opinion here, it will have not escaped your attention that we are all white and we are all male. It's an apology because we tried very hard not to be all white, all male, and we failed. The fact that we failed, I would simply say, is a reason recognising that we still have a lot more to do in the industry and bringing in diversity, particularly in this area. So an apology. I can't do much about it, but I think I'm making the point that we shouldn't have that going forward. Enough of that. Again, if I could remind you, prep you to ask questions. I've got lights shining here, so hopefully you'll have to wave your hand if you've got a question. And if you've got a question, do just stick your hand up. But in the meantime, John, if I can come to you, as one of the biggest investors in the retail and leisure sector in the UK, what do you make of all of this suggestion?
Well, thanks, Mark. I find it very helpful, actually. I think the classification reads well. It's logical, it's descriptive, narrative feels right. It allows a degree of interpretation. It will clearly need to be sort of refined and refreshed periodically. And dare I say, I expect that many investment professionals will still continue to use prime and secondary by reference. That is very much, I think, ingrained into the vocab of our industry. But overall, it will improve understanding and consistency for investors, for analysts, for lenders. I think its success will really depend on adoption by the valuation houses, and I was pleased to hear Charlie referencing Knight Frank adopting it. We need that right across the piece so that all the valuation houses are working off the same hymn sheet. And I think that will make life a lot easier. That's no small task for them because they've got historic data sets to sort out. And wider buy-in as well from other parts of our industry, some of the research houses and so forth. We need to have an eye to any unintended consequences. So I would just mention the sort of regulatory position. So as you provide more clarification, when you do mergers and acquisitions, you might get a little bit more focus using this classification. So probably a word of sort of caution that in the consultation we must just be aware, alerts to unintended consequences. I think this has also got wider application, potentially in the sort of performance measurement piece as well, through IPD, and trying to encourage IPD to be a little bit more focused on how they analyse the returns and report them. And another spin-off, potentially on service charges, in the way that to sort of help our thinking about the service levels that we deploy, the specification, the cost between the different types of retail assets. An opportunity for retail parks. We are one retail now, and we really need to embrace that. So I was pleased to hear you, Mark, reference that is very much in the thinking. And I think we should accelerate that. I think we should be doing that now and immediately as part of the launch. And just a reference to the Institute of Place Management as well, because they've recently done some work on town centres and the classifications in town centres via footfall. So again, overall, I think very positive, but it's all down to communication around the industry and the valuation houses.
Thank you. Lawrence, from your perspective, you've both, well, you are not from these shores, you've worked in Asia, you have international investors. What's the take from an international perspective on what we're trying to do?
I think if anyone that's visited the ICSC, International Council of Shopping Centres website, and gone to a tab there that says, that's called Shopping Centre Typology, you'll see that nearly every other major market in the world has a form of shopping centre categorisation, and it's more refined than traditionally we've adopted here, the primary and secondary. So I think from a global perspective, and having worked in markets where these classifications exist, and the industry just adopts it. And as John has mentioned, valuers refer to it, retailers refer to it, investors refer to it, so it's a widely adopted and recognised, footfalls categorised and reported on against those categories. It just provides a lot more clarity in the industry, and I think we're at a period in retail. Certainly I work for a listed company. We're valued every day at about 5 p.m, about 5 minutes past 5 normally. The market, the investment community is crying out for a stronger piece of communication around retail and retail property. And I don't think this will solve it in itself, but it's an important step on that journey. And so I think it's important at numerous levels, Mark. And as I say, having worked in markets for 20 years where this exists, I think it's I'm very optimistic about looking back on this in 5 years' time and us all being able to say it was a really important step in the journey of communicating the changes that are taking place in our sector.
Now, I know we're all very proud of being British and that our way has got to be the best way, but given that everywhere else in the world they have different classifications, why aren't we just adopting those?
I think rightfully proud to be British and dual citizen as well. I think the UK market is different, and I've worked in China and Singapore and India and spent a lot of time in the US in my career. Each of those markets is different, to be honest, and I think the great opportunity we've had is to start from scratch in 2018 rather than other markets that are still relying on categorisation that dates back 20, 30, 40 years. So I think we've been able to take a more contemporary approach. Let's face it, retailing is changing constantly and evolving. So I think that's been an enormous plus from our standpoint. And I think it also acknowledges the important role that, as you mentioned in the introduction, that retail parks play in this market. It's a different role to the role that they play in other markets. In the US, power centres. In Asia, they're less prevalent. They're typically functional. Out of town is very functional. And I think the other role that I'm looking forward to embracing as part of this is the very important role of our town centres and high streets. So, and they're all unique aspects of this market.
Is Mike? I'm going to ask a valuer question. There's a As a valuer, what are your thoughts? And I haven't prompted you at all, so you can say what you like. Is it on?
Is it on? Yeah, you can hear me now, yeah. Well, thank you, Mark. I think my first observation is obviously, I think we share the views. I think I share the view that Mark made, that clarity is very helpful. I would like to say that as relatively sophisticated valuers, we've probably been thinking about these things for quite a while. I do fully endorse the idea that prime and secondary are pretty outmoded. I think if these descriptions are helpful to us, if they help sort of clarify the purpose for the schemes, and we've had these conversations previously, I think in turn that helps us then engage as valuers and indeed possibly the wider community in sort of gauging how successful in fulfilling those purposes that is. I would just say a couple of potentially contentious things since I have the opportunity to do that. I think obviously we're talking about pricing, we're talking about yields here. Obviously in our view the yield that's applicable is obviously a function of two things, which is growth potential and risk, going back to the fundamentals there. Obviously we're in a curious state right now, I think, in terms of how those factors are going to play out. So I think this classification is going to be interesting in that respect. The other factors which I think are going to be coming to the fore now is obviously we valued based on tone in the past, rental tone. That's traditionally been the way that growth has been driven forward at shopping centres. I think that model is probably going to be outmoded now, so the idea of ratcheting growth forward on an upward-only basis is probably now historic. I think lease length and income security are also things which are shifting a lot. So I think we're going to end up fundamentally in a new area where we're looking at things like tenant mix, we're looking at affordability, trading potential, and ultimately how that is going to drive growth forward. So there's an awful lot of things shifting at the moment, so a bit of structure around it is a helpful start, but I think there's a lot more to come.
Graham, thank you. I'm going to pose the rest of the valuation questions back to Charlie, because that's putting you on the spot. Charlie, you've put up some very helpful graphs there showing historic yield patterns based on prime, secondary, tertiary. Are we going to have to rewrite those graphs?
Yeah, I think the inevitable next step now that we've got the definitions is for all the main houses, both investment and valuation colleagues, to sit down and agree how to use these new definitions when it comes to valuation. And In the past, as I alluded to in my brief presentation, we've had slightly different definition as to what is prime, what is secondary, and are we valuing best in class or midpoint or a range? And I think all of that, we need to get on the same page, and that will greatly help the market, that Knight Frank are talking the same language as CBRE, talking the same language as Jones Lang, Savills and Cushman's. And that, I think, is a really important piece. That will come in over the period that you alluded to, Mark, the next 3 or 4 months. Rewriting the historic yields is possibly the hardest part of that, but absolutely needs to be done. I'm not going to be standing here with a graph with 4 lines up to 2018 and 4 different colours from then onwards. I'm not sure that's going to provide anyone with a great deal of clarity. So we do need to do that. That's challenging. That will take some time. But going forward, you should be able to then say, we're putting this yield on this range. As I think Mark alluded to, that doesn't mean all centres are worth 5% in that category, if that's the number. That is a guide as to a starting point, and then you have to look at a myriad of criteria to see whether actually you should be better, should be worse. And you will find huge variation within the sectors. And you may well be right, Mark, you may well find a convenience scheme at a keener yield than a regionally dominant scheme. It wouldn't be the slightest surprise to see that, particularly where you've got 20 years supermarket income making up half the income, and you're valuing that at 4%. If regionally dominant survive enough, that's probably going to happen next year, to be honest. Yeah. So there's huge challenges in valuation, but the most important thing is that we're all on the same page, because we haven't been, in my working career, it's been an element of just doing your own thing and ploughing on and ignoring what the others are saying, and that's created confusion. So from here on, a consensus, we're working together, and that's going to happen in the next 3 months.
This is actually a question for both of you. At one stage we did have London as a special category, so we lifted the London schemes out of categorisation because they are a bit special and clearly more expensive than the rest. How do you do that currently? Is that something you do when you...
Well, that comes in at individual asset level at the moment, and probably still will. It's no secret that London schemes are, to a degree, insulated from the distress that we're seeing in the rest of the market, partly because the retail occupational market is better inside the M25, but partly the plan B, C and D in terms of residential, even industrial, is probably there if you need to replace the retail space. So I don't think we need a separate category, but you can expect significant variation from the normal yield within that inside the M25, and possibly even in the halo around it. But I think that comes down to individual asset level assessment rather than trying to create a category that says everything in London is X.
Lawrence, do you think that this is going to lead to an increase in the value of your assets by this classification?
I'm very pleased that our valuer is one of the people who has commented, so I'm looking forward to having the year-end valuation discussion. But I think, I don't know whether it will lead to better valuations or not, I just think deeper understanding, because at the end of the day, I was always taught a cap rate is a proxy for the quality of the underlying income. And I think what this is about is providing greater clarity around the quality of the underlying income. And I think Graham said, Charlie said the same thing. So I think you might see greater disparity fundamentally. I've always believed value doesn't move down, necessarily down the so-called primary, secondary, tertiary value chart. I think that I've seen many examples of very good regionally dominant schemes, and I've seen examples of poor regionally dominant schemes. We've seen great examples of very high quality community centres that have traded at very keen cap rates, and we've seen examples of poor quality community shopping centres that have failed to sell and continue to fail to sell. So I think getting that understanding around the quality of the underlying income, the sustainability, the risk that sits in there, its growth potential, I think that's really at the heart of what we're discussing, and that is at the heart of value, if I'm honest with you. And we're not going to run away from that. We've got some schemes that are, we think we've got very high quality underlying characteristics. We've got others where we've got work to do. So I think we fully appreciate it. But the other point I'd like to make, and we think it's an important one, we've done a lot of what we call guest research. We call the people who visit our centres guests, our customers are our retailers. And we do a lot of work with some of the organisations that support Revo, Javelin and CACI, for example. But I've never once heard in an intercept or customer focus group our customers say, or guests say, I want your secondary shopping centre. They just don't refer to them. They refer to them by function, and they're very sophisticated about it. We own a shopping centre in Ilford. It's 4 stops away from Westfield Stratford. We've established that our customer in Ilford goes to Stratford probably once every 4 to 6 weeks. They're with us every 1 to 2 times a week on average. They're highly complementary visits, they're not competitive visits. And I think that's another point of clarity that will start to emerge out of this, is the role and the function of these retail venues through the eyes of the end user ultimately, which is the important thing. I think the interesting thing from my perspective, when you look at the CVAs that have taken place, if you believe the prime secondary argument in tertiary, all the CVA closures should have been the tertiary centres. But they haven't been. There's been closures on Oxford Street. There's been, the major malls have been affected by these CVAs. So I think the retailer audience is the other interesting one. I know there's been consultation with them through this, and I know they've been very supportive. So I think from a stakeholder standpoint, there's some very encouraging signals.
Charlie,
yeah, I think if anyone's worried about valuation impact at the hands of this change, they're misunderstanding what we're going to do and the purpose of it. These categories and the yields that we'll end up putting on these categories don't drive the value of a shopping centre. The value of a shopping centre is derived by a multitude of inputs, and a great deal of intelligence and knowledge goes into producing the end number. The yield guide then reflects market trends. So your yield guide and your yield graph is useful to see where the market is moving, in, out, flat, looking at historic numbers. At any point in time, it's not going to give you the value of a centre because of the huge degree of variation you've got at asset level. So this recategorisation does not drive value. This reports value, and it is now our responsibility to report that in the right way. So I don't think anyone should have any concerns about valuation impact at the hands of this, positive or negative. That is not going to happen. If that does happen, you've got it wrong.
You share that view, John?
Yeah, I think I would very much share that view. I mean, retail's out of favour for completely different reasons. We've got structural change. We all know about that. The online, the changing consumer shopping habits, the challenge of securing, income from online, the true value of the physical store. Leasing is getting really expensive. Short, flexible leases, the costs of renewals and professional fees, the rent freeze, the capital packages, the non-recoverables. That's another influencing factor. The oversupply of retail in the UK, that we've just got too much and we've got to work it out the system. That's not a 2-year project. It's a 10-year project. Rental growth. So you look across all the other sectors, and retail is lagging. If it's not negative, it's around 0. And then we've got retailer failures and CVAs in particular. And CVAs and the integrity of the lease contract is, through my lens, the biggest single issue that we've got to tackle as a real estate sector, because it's not just about retail CVAs, it's also got the potential to permeate into the other sectors. And we've seen examples in industrial and logistics. So that for me is one of the biggest issues that is impacting onto investor sentiment at the moment.
Mark, I'll bring you back on that point in a second, but are there any questions out there on any aspect? Because I suspect we're going to move into areas of CVA and risk and uncertainty in the market, and I'd like anyone's observations, comments. Does anybody disagree with anything? Morgan?
To what extent did Revo look at the classification of assets in other geographies in coming up with this classification? And you haven't adopted something that necessarily looks uniform to the US or to anywhere else. We're competing as a sector for international capital typically. And how did you think about that? And albeit I would very much second what the panel said in regards to helping to define purpose of assets and to simplify the message to capital investors. Could we, should we, why didn't you follow what applies in other geographies?
Who would like to? I know, Mark, you have a view on whether you want to answer your partner or
We obviously don't talk enough. We did actually have, the ICSC did come along to one of the sessions. So that was definitely part of the agenda. They're various, so they've got 6 different guides, so there is not one uniform thing. So we had referenced them. Very interestingly, they also said, well, actually, we haven't revisited ourselves, and as a result of you doing this, we are going to revisit it, so whatever they have will probably change. And one of the things that came through really, really strongly in the focus groups we did was changing the language to be more futuristic, of embracing where we think the market is going. So where we started with this document and where we started with the descriptions, etc., were based upon best practice from ICSC, but it really was kind of a bit backward looking. We felt to make this more, bring the document alive and make it more relevant and make it fit for purpose as we go forward, we've actually embraced the future a little bit more that we didn't find in the other nationalities classifications.
Got a question at the front here. Is there a microphone on its way?
Thank you. One of Charlie's slides compared UK prime yields at 4.7% with Europe at 4%. I wondered if that reflected higher internet shopping penetration in the UK at 25% compared to, say, Germany 18%. So a question for the panel really about, do we think that UK 25% is at a plateau? Is that, are we reaching the point where online shopping isn't going to any higher and Europe's just going to catch up that, or is there still more to come?
Well, yeah, firstly, just to draw the comparison, you're absolutely right. Yeah, internet penetration is much lower over there, and generally it would appear to me that they're just a little bit behind us in the cycle. You know, they had a pretty good year in 2017, both in terms of values and volumes in the shopping centre market, and then they've hit in 2018 where it feels the UK was in 2017. So I suspect their numbers are moving, and a degree of that is to do with the internet, but not all. I mean, the internet isn't the entire reason this sector is in trouble. There are plenty of other issues at hand there, and I suspect my colleagues will probably pick up on that. In terms of your point about saturation, we're not at saturation point yet at 25%, no, but it is important to consider that the rate of e-commerce growth is slowing. You know, it's not a J-shaped curve, so it is not going to eradicate physical shopping. The rate is slowing. It's still faster than physical sales, obviously, and there is still a move that way. Whether saturation is 28%, 30, 35, is a matter of opinion, but I think it's that sort of range rather than a huge amount more. That still leaves physical as an incredibly relevant channel for retailing going forwards. It's just about having the right space, and that's about environment or convenience, in my opinion.
Just picking up on the differential on cap rates, having bought shopping centres in Europe, I think certainly in France, the rent review structure is very different in Europe to the UK. So you're typically looking at a structure that's probably more like a supermarket lease here, for example, traded on very keen yields because they've got some form of CPI or RPI-based indexation embedded within them. And for years, the French system obviously had a replacement cost related annual indexation. Now that's been changed through legislation, but that's certainly used to, and I believe probably still does, influence the initial yield on shopping centres in that market, and to a degree in other European markets as well, but particularly in France, where annual indexation was very strong. So that's I think a point of clarification. In terms of what do we think about online penetration, we do a lot of work with research companies. I think the reality is being able to say at this stage it's going to be 35% or 30% or 20% is a challenge, but we are seeing some categories where it is starting to push back. If we assume for a moment that in the year 2000 there was zero online sales, there wasn't, but if we assume that for a moment, online sales in fashion are circa 35%. So it's interesting to look at the total market online penetration and then look at shopping centre category penetration, which is one we're a little bit more focused on. But if you look at the same period from, say, 2000 to 2018, grocery penetration's gone from almost zero to about 7 or 8%. And the reason for that is A, consumer preferences, so people still want to buy grocery physically. Secondly is the economics of online, low margin, low average price point just don't work. So from a retailer's perspective, it's not profitable. And I think those two forces are something to keep in mind. I think at the moment you've got a company like Amazon which has a near zero cost of capital by virtue of the fact that it doesn't pay tax typically and it doesn't produce a profit, that they're able to drag people into this world of faster and free delivery effectively. There's a great article in Forbes in the US a few months ago that speculated the way to send Amazon Prime bust was to order as much as you could under $38 US. So that gives you some idea of the inherent delivery costs. So every retailer we speak to still says to us it's more profitable to sell something physically than online. So I think the economic piece is something that's really, really interesting. It's going to continue to play out.
The other point I'd make is I suspect in 10 years' time we'll look back and laugh at ourselves at using language where we thought it was e-commerce versus physical, and there's this great war of one versus the other and winners and losers. Nearly all retailers these days are sort of about multi-channel. It's just about sales, about turnover, it's about profit. They're not competing with each other than the pure play retailers. And going forward, it's about physical working with online to create a better retailing business. So I think increasingly we're not seeing it as one versus the other. It's about the two working in a cooperative way to the benefit of the customer, the retailer and the landlord.
We've got, just to add to that, we've got Guillaume Pochinel sits on our board, who was the CEO of Unibuy. And Guillaume's very fond of saying in nearly every board meeting, Lawrence, the intersection of where product meets people remains incredibly relevant and important. And I think that sort of reinforces the point that Charlie's making. The physical environment has a really important role to play in terms of stimulating and creating demand.
Mark,
yeah, there's a really interesting difference between ourselves and Europe, which I've only stumbled across in the last 12 months, which I tend to bang on about now because I think it's really valid as we look forward to what might be impacting values, is everybody talks about what happened in the States. The States sort of had a bad crash, and well, we're very different here because there's 5, 6, 7, 8 times more floor space per capita in the States than there is here, and we've got slightly more than Europe, so that's why we're slightly worse off. What I find more interesting is that in the States, there's 13.6 department stores per million shoppers. In the UK, it's 11.6 department stores per shoppers. In Europe, it's 2.6. And if we look at what's happening, half the BHSs are still vacant. M&S want to close 100. Before Mike Ashley stepped in, they were going to close 31 Hoffs. Who knows where he'll end up there. Debenhams want to close 10. If they could, it'd be a multiple of that. I think the impact upon shopping centre performance, town centre performance, valuation, one of the reasons we've deliberately tried to steer the language away from just having an anchor being a department store, because I don't think that's going to be valid for a lot of schemes going forward, is we are going to see this shrinking back of average department stores that no longer serve a purpose in the day of the internet, where if you live in Grimsby and you want to buy a super dry top, 5, 10 years ago you had to go to the House of Fraser, you now order it online. That's going to be one of the massive structural changes that's going to happen. That's the sort of direction we're travelling towards Europe, and that's something we've sort of tried to embrace within the classification.
Always conscious there's a danger of groupthink, and whilst we've been out consulting, we've got the benefit of an audience here that is ad hocly attending. Does anybody disagree or want to put a counter view or a challenge or a twist to what we've been talking about? I'm going to get you all waving your hands in a minute. I'm going to ask you, do you therefore all think it's a good idea, the concept? Can you raise your hands if you think it's a good idea? Okay, could you raise your hand if you are unsure? Oh, 1, 2. Do you want to give a reason why you're unsure? Do you have a microphone? Is there a microphone? Just to... This is about naming and shaming, I should say.
Thanks, Mark. When you first introduced the piece, you were saying that this was really sort of about trying to get liquidity back into the market and trying to make it easier for banks and institutions to buy assets in the UK. By changing the way that you're going to be classifying these assets and saying that a community asset could be worth more than a regional asset, isn't that just muddying the water rather than making it easier for them? So you're going away from saying what is good, bad, or indifferent to saying these are just all retail assets, and within them there are good, bad, and indifferent.
Okay, actually you made a very good point, and I'm going to split the points out. When we went to talk to the Bank of England, to the analysts, to banking sector in general, what they wanted was some factual description. When they go to their IC and they're putting forward, because they want to lend, that's good news, the concept of going up and saying we want to lend some money to a secondary shopping centre, They just said, we ain't going to do it. We just forget it. It's too much hassle. If I can go to the investment committee and say I want to lend to an asset and they describe it in a way that is commonly understood, then they've got a good chance of getting it through. The Bank of England was really keen. They said, we want to understand what it is that people are lending money to, and those definitions, prime, secondary, tertiary, well, we understand prime, although, funnily enough, everybody describes their assets as prime, no one has secondary, so it's unhelpful. So it's the use of the language. As to whether or not it's a good asset or a bad asset, that's a different matter, so split the two parts of your concerns. One is about giving better explanation and understanding about what on earth it is that an investor in Hong Kong, a bank who lends into Broadgate, into the Shard, and then into Grimsby, what is it I'm lending to? They don't understand, and ultimately it's not their responsibility to try and understand, it's our responsibility as an industry to make it easy for them to make that decision. So it's about explanation, because the better the explanation, the lower the risk. And the lower the risk should produce better pricing over time. Equally, it may help identify areas where actually that asset is extremely risky, having now explained it, and therefore it is unfundable, but that's another point. Does anyone else have
I'll just reiterate the point I made, that this recategorisation isn't going to change the value of any asset. So if you've got what we currently call a secondary asset, that we're now going to call a convenience asset, and it's anchored by a supermarket and it's worth 5%, I think it's easier that we say it's a convenience scheme, but it's worth 5% because of these attributes, rather than it's a secondary scheme, but it's worth 5%. And it's got these attributes. All we're doing is describing the character of these assets and then explaining the valuation. And I think this is going to be an improvement, not a backward step. It's not going to change the value of the asset. So, your point about suddenly we've got a secondary asset worth 5%. It was worth 5% yesterday and it's worth 5% tomorrow. This isn't changing that. This is just explaining why in a bit more clear language.
And I think just to pick up the point about the water being muddied, I think the water's about as muddy as the 30 years I've been in this industry that I can ever recall, to be frank with you. And I think that's manifesting itself in a total strike of confidence in our sector. I work for a listed company. We're trading at a 32% discount to our net asset value, which is the valuations that are ascribed to our assets. We're not Robinson Crusoe. Our nearest peer is at 42% discount. The next peer is at 52% discount. So the capital markets are saying something, and what the capital markets are saying is, we don't understand where this is going, but we don't think it's good. So the other night we had a tough day with our shares, and I rang our broker and I said, what's happening? And he said, I've been down the sales floor, Lawrence, there isn't a single bid for retail. There's not a bid down on the sales floor. He said the market's just running scared, and a company like Debenhams has lost 2/3 of its share price in the last year. Every listed retailer's down, so it's not just a retail property story. An old chairman of mine was fond of saying, Lawrence, it's the market, it's management's job to run the company, it's the market's job to value it, and he was fond of saying to me, from where I stand, I think both are not doing a good job. I think it's the industry's job, I think there's a third line here, it's our industry's job to educate the markets now and to step in and to provide some clarity, and I think this is a step in that journey. I think John's point was an excellent point about the over-inventory that exists. Because if you do the simple math, if in 2000 we had an equilibrium of supply and demand in physical floor space, and if now 20% is online, then very simply there's 20% too much inventory. And the reality is no one's talking about it. The capital markets know that's the case. They know online's growing faster than physical, and they've assumed, unfortunately, that it's a blanket effect across the entire industry. So if we look at what's happening with the capital markets, they're not distinguishing prime and secondary, they're saying all retail. Hammerson into great assets, 50%, 40% discounts to NAV. They don't know where the income lines are going. So I think there's a real opportunity for Revo, and Mark and the two Marks have been doing a great job this year in terms of going on the front foot with Revo. I think Revo's finding its voice, which I think is fantastic, and I really think it's an opportunity for us to step in and start to educate the capital markets about where we believe the sector's going, and to try and move it from being an opaque situation for the capital markets, which is what it is today, into being translucent and ultimately more transparent.
John, do you have any comment or?
Well, that sort of risk of repetition, my perception of it is the markets are pricing the retailer failures and the uncertainty from CVAs far more than they are around necessarily the structural change in the online, because I think we articulate that case, the importance of physical, quite well. To me, it's around the economics of the leasing case, the non-recoverables, and a perception in the market that there's a mismatch on valuation. Whether that's correct or not, I'm not going to volunteer a view on, but there is clearly the market is telling the industry that it thinks our valuations are not where they need to be.
Okay, I would like to bring the matter to a close. I'd like to thank, obviously, you, the audience, for turning up. Hopefully you have found it useful. I would like to thank the panelists, not just for being on the panel here, but for the huge amount of work they have all done in terms of this process, and actually on some of the subjects that John has touched on in terms of CVAs. Revo has found its voice on behalf of the membership. A point I would like to flag about CVAs: we have gone on the front foot, as you all know, I hope you all know. There has not been a single member, and remembering we represent occupiers, investors, local authorities and consultants, not one member has criticised us for taking the stance we have done, and many of the members who you might think would potentially take a different view have been extremely supportive behind the scenes, and extremely supportive that we continue to take that stance. And so Revo, I think that the role Revo provides for you as members is very, very important. We are open to other suggestions. Mark will take over at the end of the year and will carry on the good work. But I'd like again to thank the panelists, say, not just for here, but for the amount of work that's gone into this in trying to help the industry going forward and be more productive. So thank you on behalf of the audience.